Hello everyone and welcome back to the channel. This is Fair Value Finder, and today we are taking a look at some stocks to buy and to avoid in the month of May. We've been doing this for 2 months so far. It seems to be one of the channel favorites. If I were you, I would recommend subscribing. And if you don't care to watch every single video, then at least these what to buy and to avoid each month, and then go and watch the specific video for the stocks that you're interested in, would probably be the best way to approach things. So far, the stocks that have been rated as buys, where they're undervalued and they're market outperformers, have outperformed the market. We're up almost 2.2%, while the S&P in the same time frame is up 0.23. And then the stocks that were overvalued but still had some market-beating performance are down 3.5%. So we are looking at the results that we'd really expect, and that's always good news, because on this channel, the focus is value investing and fundamentals. And in the short term, stocks are a voting machine. In the long term, they're a weighing machine. So if we can figure out what a fair value for the stock would be, a reasonable thesis for where we think it's going, and run some of the numbers, then we can get market-beating returns, something better than just sitting in the S&P. So of all the stocks that we've looked at on the channel, these are the ones that may be reasonable to buy at this point. Home Depot just recently dropped down to a low enough price where, with the returns and the dividend that they have, you're going to get a little bit better than the market return. But really, what I would rate as a buy would be anything where we'd have significant market outperformance. And at the moment, those would be Chewy. It's gone down quite a bit. I think that they still have earnings coming up. We'll have to see how those play out. Palo Alto Networks looks like you're kind of in line with markets. We look at the return as 8 to 10% on average, and you're getting almost 10% here. It is overvalued based on its current fundamentals, but based on the thesis that we put together, if you go check out the video, there's enough growth that they will likely be outperforming the market over the course of the next year. Birkenstock, I've been talking about for a while, kind of holding flat, down a little bit. I'm going to keep investing. It is kind of a newer one, but the numbers, they've been able to put together some great growth in the fair value of the stock. And if they can continue with that, then 13.5% per year would be incredible. Almost 50% outperformance of the market. Eastman Chemical, it had run into the low hundreds. I had put it on the list. Personally, I bought it back in the 70s. It's great, consistent stock with a decent dividend. And in fact, it doesn't even look like I have the dividend factored in here. So even better returns than this, because it's currently 14% undervalued. Annual returns aren't the best, but this is one of those. It's undervalued and consistent. So it depends on what you're looking for as an investor. The same would be for Steel Dynamics. Clearly underperforming the market in growth, but undervalued enough that it might be worth taking a shot at. I know I currently have a put, and looks like it's going to pay out just fine. I own a few shares, nothing too crazy. I just want exposure to steel. Vici looking like it's going to come in line with markets, essentially. After you factor in the dividend, you might be outperforming a little bit, and it's undervalued as well. So it's definitely my favorite REIT at the moment. I do own 100 shares of Vici and also 100 shares of Realty Income. I am a fan of real estate, and especially real estate that I don't even have to deal with. I just have to put up the money. Barrick Gold we looked at recently. I do think that it has some potential. Very undervalued. I don't know that it's really going to reach that fair value. It kind of stays down at these low prices that we see. But decent dividend, nice exposure to the gold markets. And like I talked about in that video, their margins are probably going to be incredible this quarter because of the price of gold and the fact that they mine and sell it. PayPal, you're looking at annual returns in line with the markets. Incredibly undervalued. I know a lot of people talk about it here on YouTube. I mean, I do agree with them. I do own some. I've made quite a bit of money trading, expecting it to go up, and it has. And then Alibaba, I've talked about quite a bit recently as well. Again, this is one I have 2 puts open on and have invested quite a bit of money because I think that it has a lot of fear that is impacting the share price and really shouldn't. I really don't want to be invested in Chinese companies, but if there are any that I would invest in, it'd be Alibaba, and I would discount it for being in China, but not to a I wouldn't cut the valuation in half just because it's a Chinese company. And the returns here look insane. I mean, you're expecting growth in line with markets, but it's more than half of what the fair value that I'm coming up with is. So of this list, the things that I'm probably going to trade and buy this month are these 9 stocks. So we added more to the list. Things are looking pretty good. If you're a dividend investor, it looks like Barrick Gold and Home Depot are reasonable stocks to buy. Yields aren't the greatest, but dividend growth rates are good, and that helps with their annual returns. And now stocks that I would avoid. And some of these are complicated, like Palantir. It's one of those stocks that is incredibly volatile. It'll go way up, go way down. I wouldn't short it. I wouldn't say that you're necessarily wrong if you're buying it, but I think the valuation is a little elevated. And they just had their earnings, and they were down 15% today. So the market agrees with me on that, but I don't think that they're going to find the same bottom that I'm seeing unless they have a terrible quarter. Snowflake, I'd put in the same boat. I feel like we're going to have a lot of growth stocks here. So stocks that I would avoid, longer list here. We have 12 of them, all of them with returns in line, if not outperforming the market, but elevated prices to the point where I don't think that it'd be reasonable to buy at this point. You're potentially looking at overpaying for what it is that you're getting. And some people may think that I'm crazy. I have MasterCard on this list. I saw there was a comment on my MasterCard video where they said that there's not going to be a dip and I'm overanalyzing and not getting into a good company. I agree. It's an incredible company, but I think there's a reasonable price to pay, and it's above that. Once we have a full annual number that I can compare to prior years, then I can maybe adjust the thesis or see if it outperformed and has a better fair value. But right now, I don't think that it's reasonable. I'm looking at essentially buying it at valuations a year and a half out from where we currently stand. And to some people, that's the premium that they're willing to pay. But I'm not trying to pay premiums on a stock. I'm trying to find something that's trading at a discount where I have a massive margin of safety, potentially 30% off of the current valuation. Outside of that, nothing is really surprising. I feel like there's a lot of hope in the share price, and the market is looking for a lot more than companies really have potential for. And I've been making money shorting Snowflake and FICO and Oracle. So I know that I've been correct. And over time, the more accurate I am in my thesis, the more likely the stock is to approach these levels. And that's how I see it. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment what other stocks we should take a look at. It's almost time that we start reanalyzing some of these stocks. And make sure that you subscribe so you can stay up to date with everything. And I'll catch you next time.